Good morning. This is Trader First Year. The date is 6/22/2021. This is a new option strangle, put and calls, taking advantage of a fall in realized volatility and overall market dispersion in Q3. Expected realized and implied vol spread to tighten back towards 300 to 400 basis points. As of today, it is 1100 basis points. This could be a very profitable trade. The TLDR, want to avoid the small print. Condensed version of the trade is pretty straightforward. It is a short vol via short front dated options and short gamma profile. End goal is to make $7,200 in 4 weeks. Potential profit is $7,200. Exposure of 1.2 million for 4 weeks. Volatility expectation. Markets are implying a move of 1.25% up or down on the S&P 500. Markets have realized a move of 0.51% up or down. The difference between what market makers are implying and what has been realized has tightened. The spread decreased to 1177 basis points. The VIX is expected to move 8.1%. The VIX is currently 1722. The VIX price range is 1861 to 15.92. The put call gamma imbalance favors more put buying, although it's been reset since quadruple witching on the 18th. The S&P is expected to move close to 1.14% up or down this week, which means the S&P could rise 11% or fall 7% above its 200-day moving average, which is 3,799.37. The S&P traded above its 50-day moving average, which is 4,181.59. The market is currently pricing in an additional 6.81% move up or down by September 17th. Full summary and rationale for the trade. The end of quadruple witching, along with no substantial changes in market positioning, will give the market a chance to remain relatively range-bound with a slight tilt to melting up during the month starting 6/21/2021, ending 7/16/2021. The rebalancing post-quadruple witching will provide traders structural opportunities to profit from selling elevated convexity into the market via put right, call right strangles, which are 5% and 4% out of the money. Traders will assume to act like insurance companies for a week selling premium, writing policies, and keeping the profit at the end of the week. Brief on trading suggestion. Due to falling realized and implied volatility through June and into July, we will temporarily be in a period of reduced swings up and down. The current market environment is favorable for traders looking to sell convexity via short straddles, strangles, call overriding, put rights, and other short vol strategies to capture alpha. The rationale for the trade. Falling realized volatility presents traders with the perfect opportunity to profit from selling volatility back into the market. A low return environment and possible negative curve with Federal Reserve balance sheet expansion as a useful backstop invite investors to re-engage in seeking to exploit timely carry trades by selling volatility back into the market. The risk for the trade. The risk is any large increase in realized volatility which causes the equity market to move up or down greater than 5% to 7% over the trade's 4-week duration. This would create substantial problems to the right or left side of the distribution curve. We would like to see the movement of less than 4% and greater than negative 4% for the full 4 weeks. Naked options level 3 required to write strangles on Google and Amazon. Preemptively answering a question about the worst case risks for the trade. How much do you owe under a large move to the left side of the distribution curve? What would happen in a market meltdown selling these strangles? And how much traders using level 3 put rights owe? I don't think this is a likely scenario, but it's a good question and highlights some of the risk associated with selling options. The good news first, traders would collect the call right premium, a whopping $3,000, about $3,600 in total, goes into their brokerage account at the close of business on Friday, July 16th. The bad news, a trader would owe about $116,000 to cover the naked short puts if the market fell 30% in the course of those 4 weeks. Anything is possible, but you would need a VVIX spike towards like 400, and you would need to see the VIX implied move closer to 350, which based on current market pricing is not something anyone is imagining is going to happen over the next 4 weeks. Overall, you go back into the trade and you can look at the amount that you would be collecting. So you can see the total income is $7,200, and that is again selling calls and puts, which are strangles, and they're 4% out of the money for the index or indices, and they're 5% out of the money for the individual equities, which are just Google and Amazon. Good luck on the trade if you take it on, and you should be pretty successful. Take care.